In this video, traders, we're going to look at creating a system for bull markets, bear markets, and sideways markets. Stay tuned. Hey traders, warm welcome to you. So, can you create a robust system that can trade bull markets, bear markets, and sideways markets and leave it chugging? I don't think you can trade those markets with the same strategy and get the results that you want. You might just about squeeze something profitable, but by far the best strategy, guys, is to split these market types into three and use three distinct systems. You know, that's just going from experience, knowing what strategies that I like to use for each one of these conditions. And I've traded bull markets, bear markets, sideways markets, different variations of them. And I know from brutal experience sometimes that actually when you try and trade a system that's been working in one market and another, it just doesn't work. And you're far better off using perhaps the risk management, using some of the aspects of that, but changing the way you do it. So let's explain some of the characteristics of these different types of markets and why it's probably better to come up with three distinct systems, and most importantly, something to distinguish when we're going from one phase to the next, because that's when you know when to stop using that system and strategy and when to bolt in the new strategy for those conditions. And that could be an indicator change or whatever. Anyway, getting ahead of ourselves a little bit, let's have a look at some of the different characteristics. So in the bull market, you've got a slow, steady chug. All the stocks are rising, everything is pushing up nicely, moving averages are crossing up. You've got a nice, steady, normally it's quite slow, right? We don't get explosive. We might get explosives, but it's not as aggressive as perhaps a bear market gets that in a second. It's a very steady buying. It's supply demand imbalance shift, just demand coming in, slow, steady, bidding the market up, new highs, drops down, new highs, and everything's fine. You know, there's no surprises there. When you get some little surprise comes out, it might fall down a little bit for a week or so, and then it chugs back up again. It just keeps undoing, it's just relentless. It's very, very resilient. The strategy would be to buy dips. So you'd have X% off the high, buy that with a stop a little bit further, buy a moving average tag, buy an oversold condition. Anything with a short-term bearish move would be when you would buy on a bull market. So if you were developing a strategy, you would look to buy some kind of dip, however you define that, whether you define it as a percentage price or an indicator or whatever, or you'd look for strong stocks to buy dip. You would just literally buy anything that was down a certain amount. And the kind of finesse point of that strategy would be where you time the buy. You don't want to be trading breakouts in bull markets so much, in my opinion. Now, this is the kind of thing that you probably would get away with, but generally bull market breakouts, generally, and listen guys, I'm generalizing here. You've got to generalize at some perspective. They tend to happen like this. So, they might break out, but they won't just blast off into the stratosphere because there's no fear there. It's just like, yeah, it's just a new high, so what? Money's still flowing in. So yes, you may well chug on, but often you get a breakout that just pauses a little bit, and then it might even dip down after the break. So the real sweet spot is on that dip. Like I say, it's buying dips. That's the key thing. It's just where you buy the dip that's important. Breakouts are slow. It's a slow chug to the upside. Look at sideways markets in comparison. Sideways markets, you're looking for a mean reversion type trade. Mean reversion means you're looking for the extension outside in trade. Extension that stretch to stretch spring, you're counter trend trading back into the middle. So when it's up and you think it's gone too far to the upside, you're shorting it for a move back to the downside. Now, that could be something like a Bollinger Band strategy, something like a fake out strategy, something like a double top strategy, that kind of thing where you're fading the initial move. There's less reward generally in sideways markets because you kind of go, hey, well, it's gone up this amount's too far. I need to have a reasonably wide stop or a position to add because I'm in mean reversion mode. It might come back to here. So the chance of success is reasonably high because it kind of generally doesn't break out too much, or if it does, it will come back in within reasons. Even if it slightly slopes up, it's still got its mean reversion characteristics. So generally less reward, although still feasible for a decent strategy. A lot of failed breakouts. So, let's say the mean reversion here, even if it's sloping up slightly, over this period of time, a lot of times you're going to get breakouts that kind of fail and push down because they don't have that surprise. They have the reason for people to be buying it at extreme levels. It might run and then just run out of puff, and then the supply demand imbalance just shifts the other way. So that's a sideways market, and you can see how different the strategies would be. Moving to a bear markets are fueled by fear. They're brutal down moves, very aggressive. They go way further than you expect. And I'd say this from kind of bad experiences when I first started trading in bear market. Brutal move, you think that's down loads, buy it, get stopped, buy it, get stopped. Now you know, hey, in a bear market, you just look for shorts. You wait for your sweet spot for shorts, and you nail those shorts because the moves are beautiful when you can get on them, but it's very, very aggressive. So very aggressive moves, driving extended downside further than you expect. Often when breaks through lows, you get real good drafts. So breakouts work nicer in bear markets than they do in bull markets because of fear, because lots of people are buying stuff too early and then you're putting the stop there to try and cap the risk, and of course that really exaggerates the supply demand imbalance. And of course, sharp rallies. Bear market rallies are some of the strongest rallies out there. So you get a brutal down move, strong rally, maybe for a day, 2 days, really, really strong. Looks like it's the end of it. Everyone piles in. Then it reverses and just getting craters through the floor. And all those people that piled in on that 1 or 2 day rally are then getting there, getting literally wiped out because they thought it was the bottom. They piled in, undid it, everyone stops under that low, and it just cascades to a new low again. So that's a different strategy in itself. You can't kind of ride it out unless you've got big wide stops to account for this, or you're trying to look for those to sell short into, or you're perhaps scalping into fresh lows to take advantage of that lack of liquidity into the lows, lack of buyers and loads of sellers, scalp that out into that. So you can see the difference in strategies. And one confusion is, guys, that some people would say is that a bull market is just a bear market flipped upside down, or a bear market normally is a bull market upside down. It's not. And if you go and look at a chart, you'll see for yourself that if you haven't traded through a bull or bear market, many people haven't. If you're fresh or reasonably new to the game, just go and have a look and see the difference. The difference is distinct. You know, there's a lot more fear there. There's a lot more kind of, maybe you get a bit of a rally in the morning in a bear market, and then bang, it gets slammed. A lot more fear, a lot more of an aggressive move, a lot more counter trend moves than you do bull markets. You do get kind of pullbacks that last a while. They're so slow as well, then they chug back up again. Much more slow, much more time to think. Bear market, you can smell the fear in the air. So the opportunities are different, the strategies are different. So going back to the initial question, creating a system for bull, bear and sideways markets, I would recommend doing 3 individual systems for each and plugging that system or strategy into the conditions that present itself for maximum potency of the system. All right, guys, keep your risk managed, whichever market you're trading, whatever system you're developing for ever market conditions. Risk management is the #1 key. See you next one. Take care. Good trading. Goodbye.